Let me first ask about the two numbers that have stood out, I think, to the street, among others, but specifically on the net interest margin and on the credit cost. You've managed to do better than the consensus had estimated. How did you achieve that?
Basically, the cost of funds came down over the last 1 year. Interest rates have been coming down, and our yield also has come down. But net, there's a positive trade for us in that whole equation. So that's what helped increase the net interest margin. And then again, as far as the credit cost is concerned, we always said that the microfinance issue was the only issue we had, and that went away, and the credit cost came down. So we had two things that came together to boost the profit like this. Is just to 1,000 crores.
And so therefore, the ROA picture looks significantly better in FY27 and going forward as well. The street is anticipating that you could hit that 1% number pretty comfortably. Whether is this going to be, first of all, par for the course? Would you even outdo that?
We think so. See, the bank is still at a build-out stage, as you know, right? It's not a fully built-out bank. Even, the bank has moved from, look at the direction, it's moved from 0 to 1. Now, this is not a terminal year of the bank. This will increase naturally because our cost-income ratio is still 70 point something. We believe in due course it has to come down to the 50s. So when that happens, ROA should increase, definitely.
Okay. Now, when you're talking about the credit growth and the mix of the products that are leading to that growth of over 20%, give us a little bit of color on that, because it seems like you're treading cautiously in this kind of an environment. You spoke about the MFI problem now going away. Is that going to have a bearing on the mix in FY27?
It is already having a bearing in the sense that if you see the incremental growth of credit over the last 1 year, a good portion has come from, let me say, mortgages, has come from corporate loans, has come from vehicle loans, and some secured business loans, so like gold, etc. So that is about 73 to 75% of the book. So it's a conscious mix, as the bank is evolving into a larger bank over the next many years. We want to be in safer and safer customer segments.
Okay. So, whether, first of all, in FY27 then, maybe towards the end of the financial year, what is the mix that you envision broadly? And as you're saying, you're moving from 0 to 1 to 2. When you reach 5, which perhaps is by the end of this decade, I'm assuming here, you can correct me, please correct me if I'm wrong. What is the kind of mix that you envision at that point?
No, when you said 0 to 1 to 2 to 5, what did you mean those numbers?
So when you said that the bank is in the build-out stage, as you were pointing out, you spoke to me, right? So when you move from this point also and you double, right, towards the end of the decade, that's what I was asking about.
Well, we can't put a number to return on assets, but I tell you that directionally it has to improve, right? When I say 1, that was return on assets.
Yeah, okay.
Now one should go up. There's no doubt about that in my mind. And you will see it year after year, you will see the progress. The direction is clear. Whether it is 2 or whether it is 1.5, the direction is, it's headed in that direction. Now coming back to 2 would be on the higher side, I would say. We're not talking those numbers yet. But coming back to our mix issue, the key thing that we are looking forward to is that, our credit cost as a percentage of the loan book, when we were capital first as a non-bank finance company, used to be like 3% or 3.5%, because that was a different segment we played. Then over the last many years, it has been 2%. Now we wanted to come down to 1.5% or 1.6%. So when you got to come down to safer and safer segments, we want to walk that path.
Okay, so that's interesting. One implication of that, though, Vaidya, just logically, is that the net interest margin would reduce over a period of time, right? Because you're playing in safer segments, the yields that you get would be naturally lower, and that's the natural progression of a bank as it grows larger. What is the kind of trajectory that you see for net interest margin in the current financial year?
So let's talk for the current year. We are looking at 5.8% this year. as compared to the current numbers you're seeing. So they should be like, we are currently 5.9, should come down to about 5.8. It's a natural progression when you become a bigger bank.
Okay. In terms of geographical spread and the growth from that perspective, what is the plan that you have for this financial year and for the foreseeable future? And how is the funding taking place? Because I understand that you have the announcement, the approval of raising funds in equity and debt. But I'm guessing that these are provisions. You don't necessarily have to go out and do that. You're very comfortable on capital adequacy as well.
That's right. We are like 15 plus on capital adequacy at this point of time. But you get AGM approval only once a year when you meet shareholders in person and taking approval. So think of it like an enabling resolution. But we do definitely intend to take it, because end of the day, it's a growing bank and return on equity is touched 9, growth is 20. That's point of time. We will definitely raise it. It's meant to be enabling, but we really mean to be taking it somewhere during the year.
Okay. And on the question of expansion, Vaidya, to say that the branch network, what is the expansion strategy for the bank, right? Because new age bank, growing bank, a lot of your younger customers will essentially be primarily digital. So you don't necessarily have to have the footprint that some of your larger banks peers will have. So what's the strategy going forward, and what are the implications, in your opinion, on the capital required for that build out?
See, if you notice the growth of the bank over the last 6 or 7 years, we are a highly digital bank.
Yes.
We built the bank like that. The way our tech stack is, the way we reach customers, the way we engage with customers, everything is digital. And digital has, dramatic payback after you've been through the initial stage of the build out. And that's what we have been through. So as a bank, we have about maybe 1,100 branches. It is important because you need to have some presence for people to know that, to get the confidence and to be around. But really, a lot of our transactions are not happening in the branches. We are like, our app is very good and people are transacting on our app in a very massive way.
So, which is what leads me, Vaidya, to our earlier conversation on the efficiencies that will kick in, right? Because ultimately you've built this tech stack, all of that spend has already been done. And as you grow your customer base, ultimately your cost is not going to dramatically increase. So your returns will just multiply quite significantly. When do you see that flywheel really taking off?
No, first of all, I don't use words like, it will multiply, because that probably be exaggerating it.
Sure.
But the way to look at it is that the incremental, I like digital has a lot of power in it. To give you an idea how strong it is, I'll share some number to you. Our cost income ratio is 70.3, but our incremental cost income ratio, because we're a new bank, so we have to say incremental, not what the past is. Incremental cost income ratio is only 56%. 56%. So you should now therefore begin to see that this bank overall cost income ratio should begin to improve.
Okay. I do want to ask about FCNRB as well, Vaidya, because everybody and each bank has a different projection for how much they expect to mop up. First, what is the kind of interest that you've seen, and what do you anticipate will be your number by the end of the quarter?
We are seeing very, very strong interest. We'll probably be only limited to the extent of how much lines of credit we can enable through our SBLC or the GIFT City. But all in all put together, we think that we should be able to raise about maybe $1.5 to $2 billion, during this period.
Okay. And what are the implications then for your cost of funds? Because for certain entities, this is actually a shot in the arm when they're struggling to get deposits, but your deposit growth is what, 17-18%. So you're not really pressed to find deposits. But how does it affect your math in the rest of the year?
See, basically, our current cost of funds is around 6%.
Sure.
Money that will come through this, and our fixed deposits is somewhere around 7.3 or so. This will come at about 6.75. And also there is some forex cover we need to take by interest, call it 7. So give or take in the immediate run, when a lot of cash comes, say $1.5 to $2 billion, there could be some impact on cost of funds. But They're playing a long game. I've always said we play a long game. These are small numbers will ease out over the next rest 1 or 2 quarters. But
okay.
net, there will be some temporary blip here or there for maybe 4-5 basis points. Then it will ease out after that.